What's up, everyone? Welcome back to the Mortgage Heroes podcast. I'm Andy.
I'm Will.
And I'm Brian.
So this week, we're going to talk about some market predictions. But before we do that, Memo's back from Egypt. Tell us about Egypt.
I was walking like an Egyptian, that's for sure.
What happened? Did we finance the pyramids or not?
You know what? It was tough. I'll tell you. But certainly, Egypt wants our dollars.
Oh, really?
Everything they asked for, tip, U.S. money, it was
really?
U.S.
Wow.
money.
Oh, interesting. Okay.
Yeah, because it was 32 of their dollars to our $1.
Wow.
You know, but then Ronnie mentioned to me, who I went there with, he mentioned a couple of weeks ago when he was there, it was 40 of their dollars to our dollar.
Oh, wow. That's a pretty big change just in a short time.
You know, we've been depreciating our money. Would you guys agree by?
Yeah. Oh, wow.
Interesting.
Yeah, so it was pretty cool. So no, I did not get the financing for the pyramid. But yes, we had fun. I learned how to walk like an Egyptian. Like I said, I had it all wrong like this, but we're good. We're good.
Awesome. Well, this week we're going to talk about three things that we know are happening in the market and what we can kind of draw some conclusions knowing those things. Some things have just really changed in the landscape of finance over just the last few weeks. So I want to make sure we talk about this. And then also we got really good news about something that was coming up on the horizon, which I'll bring up later, that finally got rescinded. Thank goodness. So who wants to go first today?
I'll start it off.
Okay, Brian.
No, you know what?
All right. Let's go.
Okay, perfect.
Youth.
So just like last week we spoke on the podcast, one of our clients competed against 30 plus offers.
Yeah.
Meaning that 29 of them still, were out of a house. So that's one of the things that we're starting to see in this present market here in San Diego, that a lot of people are still out there shopping for houses, sending multiple offers in, and it's a frenzy.
Sorry, wait, Brian. 30 offers.
30 offers.
30.
Yeah, 30.
What was the price range?
The price range was 5.
Okay.
We got in at 665.
Hey, before we would say that's a great price. I mean, 665 is still high.
Yeah.
But that is still within the...
But there's the demand right there.
There's still that median where that income where most of the families fit in that range.
Yeah.
So one of the things there for my advice is be flexible with your offer and also just be realistic with your plan and your approach. So there was a slight window earlier in the year where there was a buyer's market or some sort of site that it was going to be a buyer's market, but that got gobbled up real quick.
I like how you say that, gobbled up.
Right, honestly did.
Yeah.
We saw it and it's gone now.
Yeah, gone.
So, that's just, how I'd be looking at the market if I was in entering it myself or presently in it. Secondly, what I'm seeing right now is that strongly approved buyers are the ones that are having the opportunities of getting their offers accepted or winning right now compared to, maxed out buyers that are like debt to income ratio, 1% before they're out of the approval.
Right.
So that's something that I am seeing right now, that people that do have the strong approvals, that do have the bigger down payments, that do have, their money right, and they have a secure, stable income, they're the ones that are winning in real estate right now.
And when you're saying fully approved, can you elaborate more on that? Because we just think, hey, I went to the bank. Brian, I went to the bank, I got approved.
Right. So
is that a good approval?
So what I mean is that we've thoroughly already, verified their income, their credit, and their assets. So we know exactly what their profile is looking like. So at the time that they do get in, we're able to pivot quickly and get the loan approved. So it's not just a pre-qualification where we say, hey, based on the information that you've telling me right now, it sounds like you're not a liar and you're telling the truth.
Yeah.
So by the time that I verify your documents, everything will be right.
Got it.
And we know that's not always the story. So that's definitely what I mean by stronger, fully approved buyers. And one of the last things that I do want to say, on my second point is that right now, if you want to win, you have to have, that competitive edge.
Yeah.
Meaning don't try to ask for credits if the offer doesn't make sense for you to ask. Like if you're coming in at asking price and asking for a $15,000 credit, like, that doesn't make sense right now, nor is it going to fly. So definitely, have a realistic approach when you're sitting down and writing up those offers with your agent, and let them be your eyes and your ears in the ground of what's happening. They're the true professionals. So I understand maybe you might get influenced by your tia, your uncle, your coworker, or your managers at work, but the truth is that they aren't doing real estate every day. They aren't seeing the markets like, the professionals are. We take most of our days following with the trend, seeing what's happening with the numbers so that we can give our, clients, our partners, their true information so that they can make the right decision.
Absolutely.
And to close it up on my end, I believe that we're yet to see more layoffs in the economy.
Okay.
You know, I've been following the earning reports of certain companies, and it doesn't look as hot as we'd want them to in certain, economic sectors. So what I believe is that, as the year progresses, we'll see more layoffs, which by default, I think will cause certain homeowners to have to sell their houses. And I've been mentioning this before, in past episodes, but I still believe that, we will still see a little bit more blood. People will have to lose their homes, unfortunately. And that's going to create a surge of inventory that's going to, come to the market, which I believe will stabilize the prices, not completely drop, but stabilize them, because as you saw, we got 30 people offering on a house.
Yeah.
If we get 30 houses, 40 houses, that's barely going to put us right where the demand's at.
That's
So
crazy.
So I believe that, and I could be wrong, but this is what I firmly believe from what I've been following, is that, we're still going to see more layoffs that will cost more inventory, that's going to, stabilize the market. But I don't believe it's going to crash or, completely go to mayhem like people are expecting it to, because of the fact that equity's still there. Rates are starting to stabilize. We just saw last week that the Fed said, hey, one more quarter percentage hike, and then we're going to see what's happening.
We're done.
Or we'll see, which is signs that, something is happening. Things are moving in the right direction, or towards it. So that's what I believe is happening, and what I've been experiencing. So I think moving along the line, just staying up to date and understanding what's happening.
You bring that up, and I have to agree 100% with what you have to say. We have a cycle, right?
Yeah.
And everybody used to say we have 10 years off, and then 4 or 5 that are really good.
Yes.
But if we look at the unemployment back in, I want to say 1982-ish, unemployment was at 10% in California. I'm not looking at all the other states. Yeah. But in 92, we had the same effect. So it just kind of went, things got back, and then again, it happened around 2010.
Yeah.
20 years later, it happened again. And that's when we were seeing the prices of homes going down, right? We started seeing more inventory. Right now, our current unemployment is still great. It's at 4% here in San Diego. But prior to the pandemic, we were seeing that spike. That spike was up there. And I remember, if you guys remember, that March, banks didn't want our loans.
We were just talking about it. We're like, hey, rates dropped, but banks are like, no, we don't want your loan.
We don't want it. And we're like, well, what do you mean?
Whoa.
The going rate right now is 3%, and you're offering 4.5%, 5%. That's when the banks were telling us, we don't want your
loan. And it was
right
across
now.
the board, no
because
matter
we don't
where
know what's
going
to happen.
Exactly.
Right, they didn't know.
They still had they lost no amnesia to what happened in 2008-9 with the mortgage meltdown. And obviously these big banks, they have this huge financial people that back them, that get all this data. So there was something going on that we didn't know at that time. But unemployment was starting to creep up. And then all of a sudden, we had all this influx of stimulus package. Did you get a check of that at the stimulus? I know I didn't.
I had to go work for mine.
But we started seeing the Fed just put all this money out there, and all of a sudden, hey, we got a prosperous economy once again. Home prices going up, interest rates in the twos. I never thought we would say. And I remember at 2 1/4, somebody saying, hey, I could get a 1.9.
That's what I was going to say. If you played your cards right, you could have got a 1.99%.
1.9, So these things were happening. So I have to agree 100%. We haven't seen that. Employment right now in California is at 4%. Is but the information that we've gathered.
That was real good, Brian. Actually, you're gonna
good job.
Thank
you. Good, everyone.
You're gonna be surprised at the end here when I come up with a couple things that sound familiar. Memo, what do you got?
You know what? I want to also bring you back on your pre-approval. I like to be specific on what's needed so people understand. So people that are out there in a different state, what is a good pre-approval? What's provided to them to show that they're fully approved?
So right off the bat, the Mortgage Heroes, the way that we do it is we provide a DU conditional loan approval, which is basically an automated system that allows us to read all your finances and let us know if you're approved or not. Secondly, we're going to give you a customized pre-approval letter with your name, your information, your specifics, and our signature saying that, hey, we've already done the work up front, so we don't have to do any heavy lifting down the line. And lastly, I know you're out shopping on the weekends. Sometimes you give us a call. We're out with our family or, out shopping for houses ourselves. And we provide you with a mortgage calculator with 3 different scenarios so that if you need, to get some numbers on the run, you pull it up on your phone real quick, calculate the numbers, and then just give us a call to verify that the numbers are, in the ballpark.
So 3 documents.
3 documents.
Perfect. AUS approval, which if you're approved by that.
It's a golden ticket on the secondary market. And for banks, if they see that, they're like, yeah, we take it.
pre-approval, you're going to close within 21 days or less.
21 days or less.
Because now you make that possible because you have all the data.
Exactly.
Right.
Up front.
Yep.
And a calculator so that the realtor doesn't have to worry like, I can't find Brian. I can't find him.
No, you
Where's
already
my
know.
Mortgage Heroes team? Oh, let me go to that Excel sheet. Let me
Yes.
plug in the numbers.
Yeah.
Okay. It's
And
within my budget.
yeah.
I can pull the
One
trigger.
more added bonus that we give our clients is a Mortgage Heroes client portal, which on there you're able to have specifics about the market, about your mortgage calculator personalized to your information, and then a hub where you could see all your mortgage life in real life.
Yeah.
So there you go.
yeah.
I mean,
have that ready.
Yeah.
That's going to help you stand out. And that's what I want to be specific with. So
good.
Okay?
we didn't plan this out, by the way.
No,
We didn't see this out.
it's just I just I have a third grader mind. I want to know things. I'm more of a visual. Like, give me that stuff. So that's why I want to give it to them.
Yeah, I passed the test.
But mine was what I've noticed the difference moving forward now, and I think the pandemic did this is they want more face to face.
Yeah.
They want to see if you're probably concerned, like, is he winking? I almost feel like Jerome Powell, right? If he hesitates, like, there goes my rate or there goes the market, right?
Right.
But they want to see how we're treating that. So our facial expressions, whatever's happening, they want to feel that we're confident is what I'm taking. So more face to face. And they're actually now calling it future pacing. This is where you're really putting, creating an action plan for them, having clarity on what their options are.
Yeah.
So that way they can foresee when in the future, if they do identify the home, or they're looking to refinance, or they're looking to do a project, whatever it is, they want to know their options.
Yeah.
They're asking for more information is what I'm seeing.
Yeah.
Which is great.
Yeah.
So I think the better prepared we are with these things, the better we're going to serve our community.
No, and
right?
it makes perfect sense because, you go back 2 years. What information did you need when money was cheap?
Right.
Basically free. So,
Yeah.
no, 100%.
They didn't care. It was all about
Sign
the rate.
the dotted line.
Yeah, the rate.
Let's go.
Yeah, over
That's
everything.
it. That's
No.
it.
Definitely seeing that.
So we're going through that. So future pacing, guys.
Future pacing. Okay.
All right. And then the other thing is, our market, you brought this point up, but it's no longer a buyer's market.
Yeah. Yep.
We used to see when we first started your 3-2-1 buy down. Yeah, that was a new technique to try to get people to put them in a position where they're going to succeed, where their payment, it's affordable.
Yeah.
We're seeing it's just not happening.
Well, just in some of the offers that we've submitted, we have to tell our clients, like, I know when we approved you 2 months ago or a month and a half ago, the 3-2-1 was something that we were speaking about, and they're still asking, like, can we do this? And it's like, how fast did it change? Like, over a week, it's like, yo, that's not flying anymore.
Yeah.
And it brings a lot of confusion to buyers because they're like, well, we just talked about this last month.
Yeah.
That's how fast the market is moving.
Yeah, it's moving quick. And
Great point.
Again, it's all because of the shortage of homes that we have.
Mm-hmm. Yeah, demand. Demand's high.
So it's crazy. So I put that, the 3-2-1 buy down, seller's concessions, they're almost becoming prehistoric, guys.
Yeah. I know, right?
It's almost becoming prehistoric, which is crazy to say. We saw Cal FHA bring out that program.
Gobbled
it was
up.
first 500 million.
300, I heard.
Then it went to 350, and then I don't know where it ended up,
and
to
it
be
gets
honest.
lost there.
300, yeah.
And then everything was painted great. Yeah, we can do 30-day escrows. We can do this. And next thing we start hearing is the program is pretty much shut down because all the funds were just dissipated.
Yeah, they're gone
quick.
in 12 days.
Yeah,
they're spoken for in 12 days.
And we're seeing realtors putting, hey, back on the market because buyer couldn't perform on the Dream California program.
Dream,
so here we go, right?
Yeah.
So we're seeing all these things. I'll tell you guys, in my 17 years, I've never seen things change so drastically, so fast. It's so fast.
Yep.
That we got to keep a thing. And I think that's why it's, for me, this is invaluable what we do is talking on a weekly basis, giving this true data of what's happening.
100%.
We're here to serve our community.
That's good.
Our Mortgage Heroes community is our community. This is family.
100%.
This is what we want to take care of.
Well,
this is what we're all
we're
about.
talking to people all the time. They're watching our show, they're sharing it, and they're hearing what we're saying. So it's like we're accountable for it, and it's it's required that we talk about these things.
Yeah. I even went to Egypt to try to share this. this, so we'll see how that goes, right?
It helps.
I even try to become one by getting on a camel and all that good stuff.
It helps if the audience speaks English, or Spanish.
There you go. And then I actually want to share a couple of stories that we did just to kind of give more clarification what's going on, right, with the buyer's market. But we recently opened escrow. And the seller now announced, right, no seller concessions. We're not going to do a 3-2-1 buy down, but we were smart not to offer with any of that.
Yeah.
Because that's the only way it would go. In my case, it was only 5 offers there, right?
Still.
And that's what the agent says. We don't know for sure. They just counter us back with the seller multiple counter offer. Yeah. That's all we know. They could be fluffing. Who knows? Anyways, we got accepted. The seller to remain in possession for 30 days at no cost.
Oh, wow.
We used to see that back in the day.
Yeah.
Now it's coming back.
Wow.
Right? We have another one where client gets an escrow for $1 million, and this is a close, almost family. I can say that. Yeah. It's family, right? Yeah. $1 million purchase. Goes in, does his home inspection, because that's what your due diligence is as a buyer. Do your home inspection. This is the time to negotiate whatever repairs, or for you to just say, this is not my property.
Yeah.
Right? Goes in there, HVAC, comes back, it's donezo, right? Even though the house was built back in 2004. AC unit, also, they just used it to its max and had other repairs. It was about total repairs, $19,000. Seller comes back, no credit, sold as is. We already have other buyers lined up. This is $1 million house, guys.
Whoa.
Let's take pride of ownership here, right?
Wow.
So no credits, no nothing. We probably would have been happy with just give us something, 5,000 or I don't know.
Yeah.
Throw us a bone here.
Something, But guys, they're willing to pull out, put the house back
so
on the market.
They didn't have to move at all.
Let's see if we can just get more. I'll call the other person that submitted an offer. Those are the things we're seeing. Those are the facts.
That's interesting.
It's like the wild, wild west out here.
Well, so a couple things you guys have already mentioned, I already had on my list to bring to the table today. So number one was the resurgence of buyer activity here in town, like a buyer frenzy in San Diego. You with the 5 buyers story right now, Brian with the 30, and then sellers not budging in accordance to that. Like, I don't have to move. So now it's like the table has shifted back into sellers' benefit once again, not only because the market had a soft correction, but now has maintained its price. And now people are outbidding each other again. Like, I thought we just said like 2 months ago that was dead, and now it's back again.
It's back.
And I think part of that has to do with buyer behavior that has changed and modified and adapted to the fact that the rate environment we're in now is the one that we're expecting to have happen for the rest of the year.
Yeah.
So that's kind of like my second thing. So it kind of dovetails. The first thing, buyer resurgence in San Diego, dovetails in the second thing, which is rates are going sideways. So the term sideways refers to it like if you look left to right on a graph chart, and every single day there's a dot where the rate was that day at closing. It's just going left and right. It's just going to the right. It's not going like really far up, really far down, really far up. Like, yes, there's some whiplash effects connected to the Fed or certain things economically happening, but in general, rates are sideways within a range of like a quarter to a half, which sounds like a lot, but think of that in the context of where we're at now. We're in the 6s. Okay, so we're talking about 6 1/4 to 6.5 or 6.75. That's
with
still dramatically higher than 2 1/4 or 3 or 3.5. So a quarter to a half point change in this kind of environment that might normally be considered a little volatile. This is kind of normal. This is just what it's at. This is what I'm seeing. And I'm watching it every day as certain things are influencing that rate. And look, the Fed not buying mortgage-backed securities is a big part of this. What they have to do to fight the economy, specifically inflation, specifically unemployment, that has a lot to do with this. So I think rates are going to go for the rest of the year sideways. I really do. I don't see any case for them to go really, really high or honestly really low. There's really there's no backstop outside of the market operating on its own devices that's coming in to force rates artificially or on purpose lower. That's number 2. Number 3 is I think that mass foreclosures are going to be avoided because people have equity. So this idea that I keep seeing, and I understand the argument from the data and the graph perspective where people are saying, oh, there's going to be unemployment and there's going to be mass foreclosures. Well, okay, so even if there are millions of people that go unemployed, first of all, only a certain part of them are homeowners. Some of them are renters already. And then of that segment, a lot of them, if they bought their house anytime before 2022, It has equity.
Oh, a ton.
So it has a ton of equity. And I don't think that all those are going to go down the line of foreclosure. Yeah. If they do, that might just be out of behavioral stubbornness or unwillingness to let go or something like that.
Yeah.
But I do think that the mass foreclosure situation is not going to happen. There will always be foreclosures because there are.
Because there has to be.
But connected specifically to a lot more unemployment throughout the rest of this year and in 2024, I think people are going to sell, take their equity, pay off their debt, keep out of bankruptcy, that kind of thing.
No, I agree 100% with you. I mean, if one thing we learned with COVID, when people couldn't make their payments, one of the things they did was, hey, no payments for 6 months. We'll put you on a forbearance.
Right.
And then they extended that. Oh, you can go for a year.
For a year, yeah.
Right? And then they kind of extended that too. It was kind of like on a case-by-case basis.
Right.
And then when the year was done, what did they do? They modified your loan.
That's exactly. I feel that
they modified their loan.
I feel that nowadays the banks, based on what already happened in 2008, they have a better idea of how to control this,
maneuver,
or have better ways, exit routes, right?
Yeah.
So I was actually just talking to Mikey, and he was saying, "Hey, this guy has a pre-foreclosure. You think that he could sell this?" I was like, "Well, think about it. Do you think the bank's gonna want to lose out on their investment?"
Yeah.
I believe it's more beneficial for the bank to say, "Hey, let me do a loan modification, or let me do something to your loan. Keep the loan, continue collecting the payments, so I don't lose out on that, and then that takes forever for me to recuperate my investment because it takes legalities and goes into a whole different black hole to get the house."
Yeah. And again, depending on the value of the home, if it doesn't have much equity, they rather just say, "Hey, let's be done. Let's close off on this and let's put it on the books, right? As a loss, right? And let's go at this, right?"
Exactly.
It's just different ways to handle and maneuver.
So I have a bonus today to kind of like wrap things up. The bonus is how people are learning and sharing information has dramatically changed since 2020. Whoa. But I will tell you, like right now in 2023, I've seen a few people kind of double down on their content or triple down on their content. I know that was our proactive decision coming into the end of 2022. We spent all the fourth quarter getting ready to do all this. We knew that this was going to happen and we'd have to communicate in this way. So as a bonus, though, the thing is that when people are trying to cross-check information, learn something new, ask a question, fill in the blanks on things they are unaware of, this is really important. Yeah. So I think that the behavior of people seeking information out through podcasts, video, and then asking questions in the comments, DMs, or contacting you guys directly, I think that's going to happen for the rest of this year and definitely into 2024 and 2025.
Continue changing.
Yeah.
I feel like, taking that forefront and that responsibility also gives us that, how do I say it, that responsibility to go out and say, hey, I have to go learn what's happening. I have to understand what's happening. And then I have to prepare it in a way that, I could give it back to my, to my audience, to our clients, to our database so that they can understand it. So I feel it's like our fiduciary duty to become a local broadcaster to our community. And give them almost a hyper localized, information so that they can understand what's really happening through lenses of people that, one, they trust, two, they already done business with, and three, they are actually part of your community and not some sort of, news broadcasting, big national television that's, just putting everything together and averaging it out and telling you, hey, this is what's happening everywhere.
Yeah, and we're bringing, even in this conversation today, you have three different perspectives, some where we see how different things, but then we're also corroborating and saying similar things, but then also different years of experience and different sides of the business. So I think that this brings a really like kind of whole 360 perspective to any conversation, and it keeps us sharp. Yeah. It honestly keeps all of us sharp to show up and know we got to talk about something that's going to be watched and listened to by someone who's got questions or needs help.
And the neat thing, the neat part about it is you work with different people.
Yeah,
that's correct.
Completely different demographics all around.
We're hearing about the same thing. You know what I mean? So that's what gives us all the leverage because, we're pretty in our organization. I know we're a branch of, but we have several loan officers that are all talking the same language right now.
Yeah.
But some of us just don't, put it out there. Yep. I'm not gonna go TikToking and put the note. I just don't want. I don't know how to. I don't know how to dance. I have two left feet, right? And second, I can't talk while I'm doing something else.
So I'll be 100% honest. It was either do dancing videos or get really smart and learn about educational information. So I said, you know what? I don't see myself as a dancer. I'm gonna go learn and give that.
Learn and teach.
See, now imagine that. Do both.
Yeah. Oh my
What if
gosh.
you could do both?
The dancing teacher. Oh
That's it. You know what I mean? But hey, guys, we got some good news today. Okay. Despite everything that's going on, we had a huge announcement.
Yes.
Yep.
And something got rescinded.
Yes. Yes.
Right? And I know Andy's excited. So
I'm super excited about this.
You take it home with
Take us home, Andy.
So final point for the day. Today, the DTI loan level pricing adjustments that were supposed to go into effect August 1st, 2023 are rescinded.
Done. Let's go.
Thank goodness. So this is
Finally.
very similar to the credit score loan level price adjustment we just did a show about, where there's basically a hit to people with better credit and a relief to those with worse credit in the cost to deliver loans to Fannie and Freddie. Now, we had a delay in this DTI one where if your debt to income ratio is 40% or higher, you were going to have a higher cost to your rate to deliver the loan for a conventional loan. And they had pushed this back and it was going to start on August 1st. And today we just found out it has been rescinded. And it is the best news because I also think, this was a projection and a prediction I made like a couple weeks ago. I was like, I think we're going to see the same thing happen for the credit score LLPA due to unpopularity, industry pressure, or the illegality of how it came in to be passed.
Yeah. Whoa. If you have not signed the petition that we put out there, sign it, please.
Yes, it'll be in the description of this video too.
I'm saying it.
There you go. That way, these things get rescinded like this debt to income.
Yep.
Guys, how many of our clients are above 40%?
All of them. All of them.
99%.
More than half.
I mean, come on now, guys. Let's get real. How do you not pass the 40% when rates are high?
And then the price start at 40% and you got 10% to make sure that you approve.
I mean, debate that. Let's debate that, right? Like
you can't. It's a guaranteed increased rate fee on everybody all across the board.
So I just find that that's a tactical way how to get more from the consumer. We're not protecting the consumer.
No.
How do we? Do you know what I mean? So
no.
Thank you.
Yes.
Mortgage gods for taking this away and rescinding this.
But to your point, Andy, you said if it does get rescinded, you have to wear a suit.
Oh boy.
That's if the credit score one gets rescinded. I'm gonna wear a suit on camera and we're gonna have cake.
There it is.
Wow.
Yeah.
So
all right.
If you want to make sure that you
the bet is still on.
Cake and wearing a suit, then keep tuning in because you never know
the
what's
bet is still on, guys.
And please sign that petition. So important.
Yeah, make sure we
join the movement.
There you go. All right. Well, thank you guys both for a great show today. Thanks for coming with your input and insight. And we'll be back again next week on another show. Thanks for watching, and we'll see you again then.
Bye, guys.